9, I think we can start. Good morning, everyone. Thanks very much for joining us for our Q1 report back update of 2021. It's really good to have you all here. And it's excellent to see some new names in the audience. Welcome. It's great to have you. And of course, to our investors and potential investors that regularly join us, thank you. It's always good to have you. And we really value your continued support of our business and our funds. Last but not least, I would really like to thank Olga from BCI. Olga, thank you so much for always assisting us in setting up these updates and always being available when we need you. Your support is really appreciated, so thanks very much. And this morning, we'll be having a look back over the quarter. Gareth will discuss the portfolio position and those sectors that added or detracted from our performance. And looking forward, he'll revisit the impact of rising rates on REITs and listed property, and we'll share our outlook on the asset class as well as the sectors for the rest of 2021. As always, we urge you to please ask questions throughout on the chat function, and we will open the floor to questions at the end. Greg has a few business update items that he'd like to share, so we will hear from Greg just before we open for questions. Thanks very much, Gareth. Over to you.
Thank you, Olivia, and welcome everyone again. It's the anniversary version of our virtual updates. At the current rate of South African vaccinations, we should only have about another 40 plus of these to go before we can all meet safely in person. So really hoping that doesn't happen, and by next year this time, I think hopefully we can all look back on things returning to largely normal. Let's hope. But I trust that you have all been well throughout this virtual year. So just again to run you through our funds, just having a look at the changes that we've had in the year. No real changes except since our last update. The big plus that we have now is that we have our Reitway Active Global Property Note has been running for a year. So very happy with that. I'm proud of that. Very good uptake as well that we started to see coming through for the product, which is nice. We have kept our 5-star ratings with Morningstar both in South Africa and Australia, as well as our 5 Crown ratings in South Africa and Australia. And then, as most of you will remember, have our second Raging Bull for 5-year performance that we got at the start of the year, which obviously we're very proud of and will continue to work towards. Having a look at our current positioning and performance, just to run you through our geographic exposure at the moment. The bulk of our exposure is once again sitting in the US. Not really a surprise. The largest REIT market remains so. Also one of the biggest recoveries that we've seen over the last year as well, driving a lot of global performance. And obviously a very strong vaccination drive coming through that's really been performing extremely well since the start of the year. So we're very happy to see that. Europe will remain our second largest exposure, so a mix there of listings in Germany, France. Over the quarter, we have exited some of our holdings in the Nordic countries, and then we have kept our exposure to the UK. Through the quarter, it would have gone up and down a little bit, primarily on price action, but that would have come down from the highest it was within the last part of the quarter. Our exposure to Canada, China, Hong Kong, and Singapore's remained largely stable. Japan, we've started to re-enter tentatively. Still think there are potential issues with growth in Japan where we think we can find better growth in other markets, but there have been some nice recovery stories that we've started to see in Japan too, which is why we've started to go back in. And then Australia, our exposure has come down a bit. We have exited some of the holdings that we had within Australia that had actually performed very well through last year, but just basically started to top out on our profit and price targets for the year, and we chose to exit those. We'll maybe start to add a little bit more as we go forward, but at the moment we're still seeing better opportunity within other markets, primarily the USA. Our sector allocation, as you can see, we've broken it down here as to our largest exposures, and then also where our exposure differs to the index. So you'll see our largest exposure is still within the sectors that we've highlighted as being our favored ones, which would be residential, industrial, and specialized. You'll now start to see that retail has started to come up a bit more from where it was for the bulk of last year. We are seeing some, I think, green shoots in certain retail categories and certain retail counters. There were a few last year that were sold off to the point that became a little silly, to the point that we were happy to start to go back into them. But we're still very wary of a lot of generalized retail. We do think that we've seen probably overcooked recoveries since the vaccine bounce from November. So we've been pretty careful on that. Most of the plays that we've actually been involved in have worked out very well for us, especially the investment that we made in Hammerson towards the end of last year worked out extremely well for us, especially post their results. But we have harvested a lot of that because of just seeing movements of north of 60, 70% in 3 months. It just started again to move beyond values that we viewed as prudent, but we still think there is a certain way to go on Hammerson. So we still do have some holdings there. You can see our specialized numbers have come down a little bit from where they were the bulk of last year. We still again think that, especially on the data centers and towers, is people have discounted them a little bit too much over the last quarter and a bit. We're starting to see, I think, green shoots returning again to the sectors from the results we've started to see coming through there. The same in storage as well. Healthcare, again, obviously being given a very nice boost by the vaccination progress. That has a very big impact, especially on the senior housing facilities that we have there. Office is one of our largest underweights. While we don't think that office is going to be dying, there definitely is a lot more pressure, arguably, on office, even in some of the other retail sectors, for example. It's just a sector that, because of the amount of noise and opacity, it's just very unclear at the moment as to where it's going to go, where demand is going to potentially go through. There is a tug of war really between companies that are happy to keep hybrid work from home models, pure work from home models, and those who want people back in the office. So whenever you're in a situation like this, the power in the negotiation relationship really moves more towards the tenants. So we're not expecting office to see very much growth this year, but it's very early within the cycle and recovery this year. So again, we're just a bit wary of that. Again, diversified, most of the holdings and diversified will also be on the office side. Most of our diversified exposure will be through Japanese companies, which have a very, very large portfolios and a very large mix of office, retail, residential assets, etc. And then you'll remember we started to enter gaming towards the end of last year. The net leases there performed very well for us over the quarter as well, so I'm very happy to see there. Also one of the sectors that definitely was quite irrationally oversold, and then you'll see our cash holdings are pretty small at the moment. So very different from a year ago. As you'd remember, a year ago, we would have been close to the 20% on the cash. Our top 10 holdings, again, you will see our preferred sectors very well represented in here. And then, as I mentioned, it's a bit more of a return of some of the retail names starting to come through here. So Simon Property Group performed very well this year, along with Hammerson. Remember, Hammerson was in our top 10 at our last quarterly review, but just on the very strong price action that we saw in March, we did harvest quite a large percentage of the holdings that we had within Hammerson. We've kept a smaller exposure to the company. Very strong performance coming through from storage globally, very strong numbers that we saw coming through in Q1, being reported in Canada, the UK and the US definitely. So we're very happy again with the exposure we've kept there. If anything, the market for most of last year discounted far too highly, I think, the performance that storage would deliver. Storage is an asset class that does very well during periods of disruption. I think the market seemed to forget that for a lot of last year, and and then was reminded of it in the numbers that we saw coming through out of Q4. Good exposure again, as we've had to the healthcare giants. Welltower, very strong recovery in the counter, especially with their senior housing exposure, and the vaccine impact there has been very measurable for the group. On our residential side, again, some communities, just very strong demand within the Sunbelt, a perennial star performer for us. Same with Avalon Bay. And then we have very small office exposure in the top 10 within Alexandria, but they actually have a very forward-looking office exposure. So it's a lot of their exposures on the health sciences side, high technology, not just your very traditional type office holdings that you'd see in some of the other main office companies too. So they actually have performed quite well. I think it has remained under a little bit of pressure sector-wise, but Alexandria certainly has been a star within the sector. Our performance on a rolling 3-year basis, net of fees, we remain very proud and happy with our performance. Q1 was definitely a volatile period for us. I think we are not as happy with our performance that we managed to deliver within in Q1, especially this year versus last year. We saw very strong returns coming through to some of the sectors that we have underweight and continue to actually underweight, because we do think the market is just potentially overreacting at the moment and ignoring real economic factors as we go forward. But on a rolling basis, we still are very comfortable with our position, especially versus our peers and especially versus the index. This would just be our performance versus the index over 1 year through to 7 years and plus. As you know, we're in our 9th year of performance, which we're very happy with. All years past 1 year, we remain the top performing fund within South Africa, and obviously we have a long-term focus. We have a long-term focus on delivering sustained outperformance over the long run. So we do at times know that our performance in the short run will vary from the market, but we do make that up, as you would have seen, especially if you think back to a year ago this stage. So when we look at the very large bounces that we had coming through, primarily on the retail stocks during the vaccine bounce, it has resulted in us underperforming the index to a degree over a 1 year basis. Obviously, we are not happy with that. Working hard on making sure as to whether it's something that we are missing, which we do not believe we have. We do believe that the market is just completely overvaluing, especially some of the weaker retail stocks at the moment, and some of the office stocks as well, which we saw very strong runs within Q1. Our performance over a year, we also just like to show all our funds within their local currency denominations as well there, just to give you a view on that versus the index. Very pleased with the performance that we have coming through from our enhanced fund in Malta, and the hedge fund locally, which is the same fund as just in Malta, obviously would be in USD, and locally in ZAR. That fund was lagging a little bit towards the end of last year, but we've just had a very strong look at that, and we've started to see it normalizing as trade conditions have improved. As you'll know, the only difference with that master fund is the 30% leverage there. So with the recovery that you started to have coming through in a lot more positive months, that leverage really has started to deliver. I'm very happy with that. And then you'll notice that we now have a 1 year track record, as I mentioned, on our global property note. And again, very happy with the performance of that within its first year too. Also, just looking for what we'd like to keep highlighting is our performance since the start really of COVID to now. Obviously, we are not out of this by a long shot. Volatility really has just been off the charts for the past year and a quarter. We don't see it going away. We do think that active management again will continue to bear fruit. So obviously within easy rising markets and big bounces is indices manage to capture all of that and miss nothing. But obviously when markets are going down, they're also unable to escape any of the downturn too. So, it's very, if we can have a look at that, at the period of the COVID crash, is we really did manage to protect our investors in the portfolio from the worst ravages of the downturn. This chart here will be ourselves in orange, the index in blue, and our peer competitive funds within grey. You'll also notice, we did have some very strong bounces as well that came through, just following the COVID crash. But quite often you'll see that those seem to go away over time too. We did also have a couple of funds that managed to harvest the bulk of the vaccine bounce. We were actually starting to transition into having a little bit more exposure. Prior to that happening, it was just, it's a timing issue within the market. You can't always manage to get it perfectly timed. Obviously, it's something we like and try and do, but we have managed to stabilize and start to, I think, recover quite well. But the important thing to note is that since the start of COVID to the end of last month, is we have very strongly outperformed the market, our peers, and we still have outperformed the index by just close to 20% from the start of last year to the current period, which we do believe is very strong performance and we're very happy with. If we just have a look, it's very important, as you guys know, we focus heavily on making sure that we get our sector selection right. As you would have seen at the start of last year, that was vitally important. And this year as well, again, it has proved how vitally important it is too. Our underexposure to especially the retail bounce, with this, our negative views on the sector have hampered our performance a little bit. But we do believe that as things start to play out, is we will still remain correct on our overweight sectors. So having a look at last year, again, you saw that extremely strong bounce within towers and data centers, losing quite a lot of steam throughout the year. Again, the point again, which again hasn't actually made sense. If we look at the underlying results, the underlying demand within data centers and towers, it actually has remained very strong for the year. The results that we've seen coming through at the end, for the Q4 results we saw being released in Q1 of this year have been very positive, very strong. The same also on industrial, which you saw again also just losing a little bit of steam towards from halfway last year. The results have just been phenomenal. We had Prologis reporting yesterday, a very strong beat of street expectations as well. We're not really surprised by that. We're still seeing huge demand for industrial assets globally. There are very few markets where you are not seeing the strong performance coming through. So we really do think that the market has got it wrong by selling off, specialized in industrial to buy retail, which you'll see on the bottom here. Again, you'll see that the vaccine bounce that came through very much was a recovery play for retail. Do we think that retail made sense at these low levels? Some of them potentially, the bulk of them not. Do we think that it made sense to bounce, almost 20% in a day and a half, actually in a couple of hours of a trading session? No, we don't, but this is what markets do. But we are long-term investors. Looking at this year, again, you would have seen the main outperformance coming through from retail very strongly, but we have started to see it running out of a little bit of steam, I think, as reality has started to come through in the markets. Most of the sectors losing a little bit of momentum towards the end of the last quarter, a little bit of that driven by, because these are all in ZAR numbers, a little bit of this driven by ZAR strength, also by worries around interest rates, which we'll discuss a little bit further. But what we've also done is just to keep things in perspective from the start of last year all the way through to now, is again, you'll see that even though you've had these very strong bounces within retail, it's not really new. We've seen them last year coming through into June and then, losing steam for months. And then, the vaccine bounce actually not even getting them back to where they had been. And then, really coming sideways for a while, bouncing, coming down a little bit. So, it's very difficult to get away from the fundamentals within retail are still under a large amount of pressure coming into this year. And the tailwinds for industrial are still there. We're still seeing them. We probably still think that the market is underselling retail to, residential to a certain degree, but we are, as mentioned, still remain quite nervous on the office side. Our outlook, globally, we are still very positive on industrial. Retail, you'll notice the difference from last time is that it's not as red as it was. So as countries start to reopen, we saw the UK reopening this month, it does bode a little bit better. But even looking at the numbers that we're seeing footfall-wise, is obviously they will be massively larger than last year this time, but they are still only 90% at best in some of the areas to the year before. So it's quite a long way to go. Office within the USA and the UK, still think are going to be the main areas under pressure. Markets that really avoided a lot of the major negative impacts of COVID, such as Australia and China, are still not seeing great results coming through from them on the office side. So again, the markets that have been under main pressure, we again think will lag even more. On the residential side, it's, I think, been a market that's very difficult for South Africans to come to grips with when you look at what's happened in Australia, the US, Canada over the past year on markets residentially. It's just been unreal how much property prices have appreciated, lack of stock. It's just quite bizarre. You are seeing tiny housing units in Toronto that are literally 150 square meters that have zero land, receiving massive multiple offers and selling in excess of what the asking price is, often of 10 to 15%, and selling for $2 million. It's just crazy, and a lot of the markets, seeing the same in the US. So it's becoming a very difficult market for a lot of younger buyers to have access to. And the plus with that is obviously it starts to get them looking more back at renting. So we've been seeing very strong results within the single family rentals, where if you're not able to afford to buy a house, you can still rent a very good house in a good area, a good school zone. So that has really helped the residential market there too. Healthcare obviously returning to normal in most markets, much more positive than last year, which has been, I think, a big relief for all of us, not just from a business point of view, but just from a human point of view, to start seeing, obviously things calm down a bit from the worst, and we're hoping that continues. Storage, as I mentioned, just it benefits from disruption. We haven't had this level of disruption for a very long time, and they have continued to benefit from that, and we think it will continue to carry on for the rest of the year. The same with the data centers and towers, especially towers. There's been a lot of resolutions around corporate action, which we started kind of seeing coming through in Q1. The numbers are looking good. We're having a good rollout on 5G globally. I think some of you might even have seen it start to become more and more prevalent within South Africa too. So I've actually, recently quite picked up that some of the cells that I use have now switched from 4G to 5G, with a big jump in 4G speed and 5G speed, which is actually really nice to see. So it's quite bizarre at the moment to actually get better speeds from my phone than from my home fiber, just because of the plan I'm on. But it really is good to see. But that's a global phenomenon that we're not seeing going away anytime soon. Looking forward as to where we're seeing the growth and our research partners. So this is a projection by Green Street, just looking at where they're seeing the best rental growths and occupancy changes, both positive and negative within the sectors. Again, they're seeing the bulk of this within industrial, manufactured housing, self-storage, and then a lot less, obviously, within mall and office. Mall and office really are plateauing. We're not expecting much growth. It actually is down significantly from where we saw it pre-COVID levels. So that's another reason why we find it a little crazy that we're seeing a lot of the retail counters would turn, especially in the US, to levels that they traded at, in February of last year. When you're considering the economic impact, the impact on rentals and the amount of vacant space that they're still going to have to absorb, it makes no sense for these things to return to those values. And we think over exuberant buyers might just be having a little bit of regret as the year rolls forward. Obviously, REITs and bond yields have become an issue again. So I think, at the start last year, this time was definitely not anything anyone thought about. But as we have a lot of money that has been put in by central banks, it has become more of an issue. We did start to see yields start to rise towards the end of last year. Whenever anything happens, is you have this chicken little scenario where we generalist investors that look at property believe that whenever there is an increase in bond yields, is that this is the death knell of property, and oh my God, we need to sell and we need to get out of it, and it's just everything is going to fall away, and guys, please, we just need to run away. But it really is not the reality. And I think if anything, we're probably quite surprised that we've ended up having to start talking about this as soon as we have as REIT specialists. So, different property types also respond very differently to changes in economic realities. They are changed on lease behavior, and some of them will be more bond-like. Again, we don't like to use that term because REITs are not bonds, despite what people may think they are businesses, and they are not. Each of these really within the sectors responds differently to changes in the economy, and also their lease durations also will then give them at times the impression of an asset class that is more like a bond, even though it isn't. So typically, it's not surprising that if you have a look at sectors like hotels, they will be very sensitive to economic changes. We saw that very clearly last year. They also have very short lease durations. This also makes them quite positive during periods where you actually have rising rates, because they're actually able to change what they charge for their spaces on a day-to-day basis. The same as you'll sometimes see in some of the other sectors, such as storage as well, for example. But storage, as we showed, is a lot less sensitive to changes in economies. As people are very attached to their goods, even though they might be under economic stress. They will still rather often pay for the storage they have to not lose what they have. And there too, obviously, where you have things like net lease, for example, these will be very large portfolios of very diverse assets, typically with very long lease periods, and they can sometimes be viewed as more bond-like, although as we say, we don't really like that. You'll see the difference really within retail, for example, with shopping centers and malls. So typically malls, quite often will have a lot more discretionary type spending, where shopping centers will be a lot more necessity driven. So they might have shorter lease durations at times, but they will actually be a little bit more defensive when it comes to economic times under pressure. So it's always just useful to think about it. Also, we've done a lot of work looking at what are the actual real changes when we start to see an increase in bonds. So typically, it's not a surprise for us that under most circumstances, when yields are rising, is that people typically panic and sell REITs and move into other sectors within the market. We obviously think this is the wrong thing to do, and typically the research results do prove it over time. So what we see is as yields rise, typically people will sell out. You'll see REITs will generally be outperformed by equities. But then the real difference that we start to see is that post these rising periods, looking and here we break it down, looking at 180 days post where rates have peaked, and a year post that, is you see a very strong performance coming through from REITs, and in general they actually do end up outperforming. general equities. Having a look at the current hiking period is what we've seen is even from the first time we started doing this table about a month and a half ago. Well, it looks like rates might just have peaked. What we saw is a very quick narrowing of the performance differential between REITs and equities coming through, within the first quarter. So not positive, the same as we saw in 2018's move, but in terms really pretty low compared to what we have historically seen. So we're quite positive again that when we look forward 180 days in a year's time, we are very positive that should things hold, is we should see a good outperformance by REITs of general equities again. NAREIT also, which is the US REIT Association, has also done a lot of work looking at what actually happens when you see the yields in 10-year treasury move, and what they have found is that when you're actually seeing these moves, is you are actually seeing pretty strong outperformance coming through from equity REITs as these things occur. So it's not something that we are surprised by, and why aren't we surprised? So the important thing to remember is that REITs are not bonds. They are businesses, and yields have a slight impact actually on the businesses that they operate, but it actually is a very small driver of real estate performance. Cap rates are more important. Outlook for economic growth is far more important. What the fundamentals are and where we are within the cycle to what the demand is like is obviously far more important than anything else. What are we seeing rental reversion wise? Are we seeing rental growth? Aren't we seeing rental growth? Is there an issue with availability to credit? If you are in a situation, yes, where credit starts to become a little tighter and rates are moving out, well, that's a big issue, but we're not seeing that, and we don't expect to see that. Historically, even though yields have moved out, the cost of debt for REITs is at a extremely low point for most of the globe. Are we, seeing FFO and AFFO growth? What are the payout ratios looking like? We're not seeing issues on these within the sectors that really concern us. What we are seeing when we're seeing rates moving at the moment is we're starting to see a normalization of the global economy, and this is actually very positive for REITs because they are businesses. So as we normalize, as people return to work, as people start to consume what they used to, and people potentially start to consume excess to get back to where they were, or just mentally tired of having been shut down for so long, we view these as very, very positive. We do see rates as being very secondary to the improvements in the economy, and most of the data we're seeing coming out of, especially the US, gives us comfort on this. So the really important thing, again, as we say, is that REITs, they're not bonds. They are businesses, and they reflect the underlying economies in which they operate, and most importantly, generate cash flows. And I'm just going to move us on to a bit of a presentation speech by Mike Kirby, who is the founder, a co-founder of Green Street, which is one of our research partners, probably one of the best research houses on global REITs that we have found and have used over many years. This is from a recent conference at the start of this month, just looking at the bull case for REITs going forward and where he's really seeing it. And I think it's quite insightful just for the next 5 or 6 minutes just to see Mike's views.
Gareth?
Gareth, there's no sound.
Yeah, I thought it was just on my side, but it seems as if it's not coming through. Can you hear me, Gareth?
Yeah, I can hear you. Is there no sound? You cannot hear the video?
No, can't hear the video. We can see it clearly, but we can't hear it.
Okay. I have a solution, so just hang on one sec. Okay, so I'm just going to, I have the video separately, so we'll see if we can play that. Let me...
Perfect.
Is that better? Can you hear that now?
Not yet. Can't hear anything yet.
Okay, that's strange. Okay. So let's see, it's on. Very irritating. Okay. 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 Okay, let's us now. I'm going to try a new share, and it should see if we can sort that out.
Okay, great.
Okay.
Still no sound for some reason.
Okay.
I mean, the video will be part of the presentation. If you have any more trouble, I mean, it will be part of the presentation and people can have a look once we share it with them.
It's very bizarre because I hear the sound completely fine on the sound. It's really weird that it is not actually doing this. Okay, let's see.
Gareth, sorry, just quickly, there should be an option for you to share your computer sound.
Okay, let's quickly
when you start sharing.
Okay. Okay, let's system. See.
There you go. Thanks, Olga.
Okay, happy there?
Yes, we can hear it now.
Okay, my apologies, everyone. I'm just going to start it again.
Still not working, Gareth.
Gareth, we've lost the sound again, so I'm not sure what happened there.
Gareth, it's been suggested if you can just summarize his views.
Okay.
So we can move on.
Okay. Okay. We'll just go back to resharing the presentation. Okay. So the gist of the presentation coming from Mike is he is primarily talking about their views on the market and how they're seeing it. He actually mentioned earlier on in the conference that they've actually had one of their business years at the moment where they've hired over 100 new people to Green Street. The plus with that is the company's growing. The minus is that you have a situation where management actually has not met the vast bulk of the people who've actually joined the company at the moment. And he again doesn't think that this can continue. But when they're looking at the numbers that they're seeing, the growth that's starting to come through, and the comparison of REITs versus the general equity market, is that their view is that they are seeing a situation at the moment where they haven't seen REITs at a level what they view as being this cheap for the last 15 years, and that is very much a positive for the sector. If we have a look, if you think back to just that the slide I showed a little bit earlier with the performance of the sectors, is that even though you've had these very big bounces within some of the sectors, they're still not even where they were at the start of last year. And I say for some of them that does make sense. For some of the other sectors, you've seen a lot of the momentum go out of them over the past few months, to the point where they have again become cheap to the point of, again, not making sense. So the real takeaway from this is that Green Street are seeing REITs as offering value that just has not been in the market for a very long time. And this, we believe, bodes very well for the year as we roll forward. And we will make that available. It's what we'll actually make available is a full links to that full discussion of the conference where Mike spoke, where it was himself as a research provider, and the other participants were REITs, US REIT CEOs, very insightful and definitely worth time on your side to watch. I'm going to hand over to Greg now, just to run us through some business changes, and then I'll just sum up in conclusion, and then we'll be very happy to take questions. And again, deep apologies from my side for not having video somehow.
Thank you, Gareth, and hello everybody. Nice to chat to you and see you, and we can always chat after the presentation. I've got 2 bits of information at this point in time relating to platforms. I'm pleased to inform you that our Malta domiciled fund has been listed on the 91 International platform, and that was the old Investec platform. Old Investec International platform, and there's been some difficulty on trying to locate it, so just quick directions. And firstly, all you have to do when you're on the quote page or the client fact sheet page or the portfolio analysis page, all you have to do is start typing an REIT, and it'll pick up the fund, and then you can get on with your business on the international platform. And by implication, it has also been listed on the Credit Suisse platform, should you want to be or are a user of Credit Suisse. Then next, we have for some time been listed on the Wealthport platform, and I'm pleased to see members of the Wealthport family participating, and we want to reach out to you and more specifically in time to come. But after discussions with Charles Brits, we will be loading another 4 of our products. So hopefully in a few weeks' time, you'll be able to see our 2 Malta domicile funds on the platform, our 2 South African funds, and then our Australian fund. There'll be further developments down the line, but welcome to Wealthport, and Charles, we're looking forward to getting having more interaction with the Wealthport family sooner rather than later. And then I've kept the best till last. Congratulations to our friend, our colleague, and our working and an integral part of our business, and that is Olga. Olga just recently got married, and from the Reitway family, Olga, we really appreciate working with you, and congratulations on this major step in your life. Thank you. That's all I have to say. If you need any more information relating to platforms or the actual funds, please don't hesitate to contact Olivia or myself. We're always available to address your needs. Is there any questions? Olivia, over to you.
Thanks, Greg. We're just going to do the conclusion, Greg.
Okay, go ahead.
Okay, so thanks, Greg. So just in conclusion, we're not seeing 2021 as becoming a year of calm and peace within the markets. Volatility is definitely here to stay for the bulk of this year. We're not seeing a return to normal for a while yet. COVID sadly is with us for a while still, and it's going to be a reality. We saw that very clearly during the first quarter, and we still have to, I think, work a long way to get through to this. Of course, the big plus, we all know the vaccines have really changed the narrative, but it very much is an unequal path through a lot of the world. Obviously, the UK has done extremely well The US has just been phenomenal in the level they've got through. Several countries have returned to normal post-vaccinations, Israel being very key amongst those. So we can see what happens when we get to a situation where the bulk of the population is vaccinated. Unfortunately for us, Africa at the moment might as well be zero, and things are moving very slowly in the rest of the world. Looking at the current numbers, from India and the ongoing numbers from Brazil, it's still a very deep concern as we move forward. The USA, I think the stimulus that we're going to start seeing coming through, we think will be constructive again for the US. We just think they're going to continue to drive things going forward. It's looking good there, touch wood, and we hope it continues, but it really does remain our favorite market at the moment. But in general, global growth really still is in recovery mode. It's going to be in recovery mode for a while. But the stimulus that we're seeing coming through in the US and potential support measures that Europe will probably have to start implementing relatively soon as well, we think will remain pretty positive for listed property. Again, not all sectors are going to benefit as much as each other. It's really going to be very important to make sure that you have your long-term sector selection right. We still remain positive on our data centers and towers, logistics and warehousing, residential, especially single family and manufactured housing too. But we do think that yes, there have been some very strong bounces within retail, but we think the reality of this is not going to be as positive as people might have been hoping for at the end of last year and within the first quarter too. Offices, it's still a long way to go to see where we end up. But again, just going back to what we had happen 5 years ago, it really, Zoom is great, Teams is great. The ability to speak to people virtually is very useful, but it really does not replace just the ease and fluidity of face-to-face communication. So, we are pretty positive that as things return to normal is eventually, the next 2 to 3 years is things that will go back to the way they were and be preferred to be that way. But it's going to be a long slog. But we again remain positive on REITs as being a very important part of your investment portfolio, and we believe that our active management will continue to deliver returns in excess of the benchmark for our investors. And I'm very happy to take any questions that you have. Thank you very much.
Gareth, we did have a question coming through on the chat,
Right.
and everyone's of course welcome to just unmute themselves now if they have any questions, but we did have one on the chat relating to the attractive valuations outside of the US at the moment. So is the UK and Europe not looking more attractive on a relative basis currently?
Well, again, it depends, sector-wise. So within the UK, things are starting to return a little bit to normal more quickly. So, within the UK, for example, we can look at a company like Hammerson, for example. The bulk of their exposure is in the UK, but they then have exposure both in Ireland and in France, which is lagging quite considerably because they are, Ireland is still under a large lockdown, slow vaccine rollout. France is under a very hard lockdown at the moment. So from a retail point of view, again, you need to be very careful regionally. When we're looking at residential, for example, within Germany, we had the very positive news last week coming through. The German Constitutional Court has overturned the freeze on rental rates hikes in Berlin. So that's very positive for German residential. So that's good. We're still seeing very strong demand coming through from there. So that within a continental point of view will be very good. But it's not going to be hugely different to the level of demand and strength that we're seeing within the USA and Canada, for example. So there's strong demand on all of those. Do we think that they'll outperform each other? It again depends on the counter and the regions, but it's looking positive. So we would be more positive, for example, on residential within Germany than we would be, for example, with Finnish residential, and would be more positive on US residential than we would be on Finnish res. So it's looking better in some parts of Europe, some parts of Central and Eastern Europe. Again, we're pretty positive on as they start to normalize the retail side. When it comes to industrial, globally, as we've seen very strong demand pretty much everywhere, especially US. Europe, again, extremely strong demand. Pipelines are very good. Rental growth is looking very attractive. Self-storage within the UK, again, is pretty good. And again, some of those UK self-storage names, for example, such as SafeStore, have exposure to France. So if we're looking at various regions, we are still seeing the US as being the driver for the bulk of normalization. But yeah, it's within Europe, there's a little bit more of a way to go, just I think because of the slow pace of vaccine rollout in the markets, the numbers they still have, and that many of the markets are still under hard lockdown conditions, which is going to delay things for a while. Whereas, for example, UK has basically started to return to normal. Scotland should be start doing that next month. Ireland potentially in the next month or two. But the US also really has got to a point where it's almost business as usual for the bulk of their sectors. So we would still overweight the US at the moment versus Europe.
Thanks, Gareth. No questions in the chat currently. So if anyone would like to ask a question, welcome to just unmute yourself and go ahead.
Sure. And obviously, so if there are no further questions, I mean, if you want to send them through offline, obviously, please don't hesitate to send it through directly to Olivia or myself, Greg, anyone in the team. We're always happy to address any questions, queries, concerns that you may have. Again, it's always great to be speaking to you. But yeah, if you have any questions you'd like to get in before the end, please don't hesitate.